Hi, welcome everyone to a third session of Know Your Mutual Fund series. Today we have with us Mr. Shailesh Jain. He's the fund manager for Tata Balanced Advantage Fund. And today we'll try to understand a little bit more about the Balanced Advantage category and also about the Balanced Advantage Fund that Tata is managing. Our aim is to give you more insights into the fund so that it empowers you to invest better. So, welcome, Mr. Shailesh. Welcome to our podcast. It's a pleasure hosting you. And if you could just begin with a quick brief about the balanced advantage as a category, and we can take it from there.
Hi Nikhil. Thank you for hosting me. Let me start with the categories. So, balance advantage funds are the newer categories which have gained prominence in last few years. Actually, to put it that way, these are a much better version of the hybrid funds or the balance funds which were earlier launched. And to put it simply, what are these funds all about? These funds are nothing but they dynamically adjust the equity allocation along with the debt allocation. So what I mean by dynamically that basically every fund will have a different way of adjusting the equity. Some will work on the PE model, some will work on the price to book and X and other parameters. But the underlying parameter is that whenever they find the market being expensive, they will cut down their equity allocation and they will increase their debt allocation. And debt, which means adjusting the balance of the equities to ensure that the equity status is intact. They will do some arbitrage strategy around it, and then the balance will be debt. Whenever they find the markets are becoming cheap, they will actually cut down their debt, increase their equity allocation, cutting their arbitrage exposure as well. So this is what the fund dynamically keeps on doing as and when they feel the markets are expensive or when the markets are cheap. Now, this actually takes care of a very, very large problem when somebody who's managing his investments into mutual funds, they really don't know when to time the market, right? I mean, they may start investing when the markets are looking very, very expensive, and suddenly they feel that in spite of their investments, they're still not getting the returns which they were expecting to, or the reverse is true. But when you have this kind of funds, it actually adjusts itself very, very well between the equity and the debt, which means what it tries to do is that it maximizes your return with limiting your drawdowns. So this is what balance advantage funds are in a nutshell. And those funds have gained significant prominence. In fact, the equity AUM at the moment would be close to anywhere close to 2,55,000, 2,60,000 crore. So it's a very, very prominent category. To my assumption or to my understanding is that a significant part of the inflow in terms of lump sum, in terms of SIP, is going to balance advantage type of funds in perpetuity now.
Right, that's great. So, thanks for the quick overview. If you could help us understand how is Tata Balanced Advantage placed compared to its peers in the category, so it will help us understand your strategy a little bit more, and then we'll get on to further details.
Right. So yeah, so thank you for this question. So let's put it that way that as I said in my previous question, what are balance advantage funds? They dynamically adjust equity and the debt. Whenever they feel the markets are cheap, they will increase the equity allocation, and whenever they feel the markets are expensive, they will cut down the equity allocation. Now you also need to understand very, very clearly that this will all be done with the equity status in mind, which means that the 65% of the equity allocation will always be intact. Whenever you reduce down your equity allocation, you will increase your ARB allocation, and whenever you want to increase your equity allocation, you will cut down your ARB allocation. Now, with this perspective, we thought of how our balance advantage fund will work. So when we were looking to launch this fund, we actually did a lot of iterations around it. That what is there in the market, what are people doing, and how we can better this product with the experience of what is already in the market now. So we realized that when people whatever funds were launched, they were either working on the PE model, right? So someone was using a trailing model, someone was using a forward PE model. Now both of this have their own pros and cons, and so let's put it simply that if someone is working on the trailing model, if the markets are growing, then your trailing will look very, very expensive. Now let's take the other case that if someone is working on the forward PE model, if the market is someone slowing down its growth, it will always look cheap. Now, and there is always with the forward, there's always some amount of ambiguity that how and what is the number which people are projecting. Now, we did a lot of maths around it, and we realized that none of this is actually a foolproof method. So what we realized that we should have a blend of both, that is both the forward and the trailing. And we what we did was that we gave them an equal weightage. So let's take equal weightage, basically 50% of the weightage to the trailing and 50% of the weightage to the forward. We came out with a blended number, and this is what the number what we use. Now, if you really go through our presentation whenever we launch this fund, we have actually created tables around it. So if so, for an example, if the PE range, the blended PE range is between 19 to 21, we will have a 40% allocation. If the blended PE falls between 17 to 19, then we will have a 15% allocation, and it goes through. The peak equity allocation what we have is around 80% equity allocation. This is I'm talking of the net long equity allocation. So basically 40 and 80 is the range what we look at the equity allocation. Now, after doing this thing, we still realize that this model is still not self-sufficient. We need something. There are times when market shows a lot of exuberance, and when in spite of the fundamental valuation may look stretched, at times we realize that we need something else to also to ensure that the investment is intact. So we actually developed a model 2 over and above the PE model. Now, what does the model 2 does? You would have realized that at multiple times when fundamentals look stretched, the market keeps on going up, or when the fundamental looks very cheap, the market still keeps on falling. Our idea was just that if the trend is positive, we should continue our investment. So what we did was that we actually put up a model 2. Now the model 2 cumulates three things. One, it captures global markets. Point B, it captures volatility, and third, it captures some momentum indicators. What we did was that we actually objectified all these things, came out with a number which actually indicates whether we need to add more equity allocation or we need to cut down equity allocation around it. So let's take that if the indicator is giving me an indication that I need to add 10% equity allocation in, so this will be over and above the PE model. So let's take a hypothetical case that at the current juncture, the equity allocation is 40 because of the PE range. So because the PE is
Okay.
trading between 19 and 21, the equity allocation as per model 1 will be 40%. What it does is that if the blend of this model 2, which I said is indicating me an addition of another 10% equity, we will add this 10% equity allocation over and above the PE model. So that will become 50%, 40 plus 10. Bearing in mind that it will never cross 80% of equity allocation. Now, there are times when market starts correcting a lot, and we start realizing that yes, the markets have become fundamentally cheap. But what happens is that maybe it is still not the correct time. There is no point in catching falling knives. So what it does is that in spite of the P looking cheap, and it indicates that the equity allocation should be 50% or 60%, but my model 2 is indicating that you need to wait some more time. We need to cut down the equity allocation still here. So even if the PE model indicates a 50% equity allocation and my model 2 indicates a minus 10% equity, we will cut down 50 minus 10, that is equal to 40% equity allocation. Bearing in mind that 40 is the bare minimum we can go down. So basically the equity allocation uh, cumulatively output from the model A and model 2 will range between 40 and 80% equity. So this is done
Got it.
dynamically. We do a rebalancing every week, and we use derivatives to hedge our position. So whatever will be the balancing figures to ensure that the equity allocation remains 65. So if the net long is 40, we will do 25-26% of arbitrage to ensure the equity allocation.
Right.
So this
Right.
is this
Got
is this is this is a very different model from where the others are doing. So basically, it has the allocation and the selection input. So it works on the allocation output, which if the allocation is correct, then comes to the selection process, which also needs to be correct. So
right.
theoretically, just sum it up, the output of the model has been quite good, and this has led to significantly lower drawdowns for us. To put it to in the perspective in terms of numbers, 30% of our returns has been generated by the model 2, which means the model 2 which says that you need to add or cut further equity over and above the P model has actually worked very well for us.
Right. So thanks a lot for sharing that in detail with us. So if I can, so since you mentioned a little bit about the valuations also, so if I can come to equity valuations and just try to understand where you are seeing equity valuations today, and are there any particular sectors or pockets where you are seeing, it being different from the broader market, either overvalued or undervalued? And how is the portfolio at Tata BAF positioned for the same?
Right, right. So yeah, so multiple questions in this question. So let me put it simply. On the valuation part, Nifty, as we all know, is fairly valued at least at this point in time in terms of its long-term average. If I just calculate the PE multiple, but having said that, India has always been an expensive market versus the globe. Simply
Right.
because we have a lot of growth opportunity in the market now. We had a stable government for 10 years, and we are going through one of the biggest election in the world now, or
Yeah.
probably if you see the biggest democratic election which is happening in the world now. So you have a significant. So the output of the election will be on the 4th of June. We still have one more phase left. But as we all know, elections are a very very big game changer in the Indian markets now. So as I said that the valuations of Nifty at the moment is fairly valued. You have mid caps and small caps near the all-time high. Nifty also is trading near the all-time high levels now. So there is no room for error now, or room for error in terms of the election output now. The biggest out or the best output from the election would be that the existing government continue with the existing policies. Having said that, if some uncertain towed event happens, then I think probably there could be some bouts of correction coming in the market now. But to whatever I have been hearing, to whatever I have been reading till now, it seems that the existing government may get its majority through. But again, I am not an expert on this subject. I am also hoping the way everybody is hoping for. But as I said that a continuation of the existing government will ensure the continuation of the existing policies, which showed a lot of stability in the market. If you really see how the books were cleaned up, the financial sector's books were clean. A lot of impetus was showcased to the defense and the railway sector. So I think those are the sectors, as I said, that will continue to gain momentum if the existing government comes. To your second part of question, that what is looking cheap and expensive, as I said, that markets are fairly valued. But in this market, there will always be some opportunity in every market, whether the markets are trading cheap or expensive. It could lead to either a sector outperformance or a stock outperformance. This market, you have lot of stocks versus where the valuations are trading cheap, or where there are bouts of opportunity. Maybe sector wise, there is a lot of sectors are already explored. But as I said that on the stock perspective, you still have a lot of opportunity in multiple stocks if you're doing a bottom up approach. To your question that what is trading cheap, I think financials or BFSI sector, to my perspective, is looking cheap. You had significant large selling by the FIs who have been a large holder in this sector. Valuations are looking cheap. Books have been cleaned, and I think the earning multiplicity, the earning momentum, or if you really see the growth, looks to be a compounding in this sector. So for me, this is one sector which is looking cheap, or probably where there are bouts of opportunity. Consumer is one sector where people have actually they are under own and also looks okay. I think a rural turnaround is on the cards. I think those will drive the staples or the consumer sector in general. That's two sectors which I personally feel have some momentum left, or where we believe as a sector perspective there is opportunity available. As I said, that stock perspective, there will be multiple stocks where bottom up opportunities will be available. But I think, as I am not I won't be able to speak on individual names on this chat
Right.
or on this discussion.
Right. So that's very helpful in terms of sectors. So once you have decided on the asset allocation by using your two models, and also identified certain pockets of both overvaluation and undervaluation in the markets, the equity markets, how do you go about selecting the individual securities? Like, what is your basic criteria, or to select which securities finally to deploy money into?
So here at Tata, what do we follow is we follow a GAP model, which is basically growth at reasonable price. We are not momentum chasers, neither we are deep value buyers. So for us, what is more important is because Balance Advantage Fund is a fund which is above the equity saving in terms of the risk and in terms of the return, but lesser than the diversified funds in terms of the risk and the return. We generally look to have more compounders in our portfolio. Having said that, we still look for opportunities where there is re-rating candidate. But bulk of our portfolio will still be compounding, where we believe that these stories is sort of well discovered, where there is a significant compounding effect in terms of its earning, and where we are not betting too much of on a single product where it is successful or not. But we are looking for stocks which will keep on multiplying their earnings year over year. So as I said, that financial is one sector where I personally believe is a more of a compounding story. So we will have a significant part of our portfolio into the financials. But having said that, we will still have some exposure to mid cap and small cap, where we believe that the earning visibility is quite high, or there is a significant turnaround in the name. So this is summing up what we have in the terms of selection process. As I said, that we still have the allocation effect, which also comes into the play, depending on what and how much will be the equity allocation at any point in time. So it will range anywhere between 40 to 80%. So once we have the allocation in mind, which is basically ranging between 40 to 80, we go to the stocks or the sectors. So on the sectors, we obviously have a drill down a few sectors on what we believe will be the potential earning, where we believe the earning visibility is high. Once we do this, we will drop down further, or we will go down further to the stocks which we believe can outperform the particular sector. So I think, having said this, we will select the stocks. Most of the stocks what we select again are what I said, where we believe that the earning visibility is high, where the management is pretty stable, the product is well discovered, there are no cash flows issues in any of the company. That will form a significant part of our portfolio. On the second part, there will be some which can give us alpha, which could typically either be where stocks where we believe that the turnaround is there, or where the cash flow is improving significantly, or where there is a slight amount of management change which can drive the earnings of the stock. So having said that, this will be a blend of stocks in our portfolio. But again, we don't buy significant deep value names. Neither we are chasing momentum, significant large momentum. Our philosophy will remain at GARP, which is growth at reasonable price.
Right. Got it. And if I can touch a little bit upon the debt portion of the fund, because that adds to some stability and consistent income in the portfolio. So, given the current interest rate scenario, what is the view of the house in terms of debt, and how have you been positioning the debt component of the fund in the balanced advantage category to ride the next few years?
Right. So though I am not an debt expert, we have a debt fund manager who manages the debt, but I will still give you a glimpse of what we are doing on the debt side. So as I said, that this is a dynamic asset allocation fund. So the equity allocation changes, and the balancing figure will obviously be the debt. But our view is that we will have one or two rate correction, or rather, if you see, there will be the RBI will cut the rates in the coming months. Our assumption is that anywhere between September to December, we will have one or two rate cuts. We are well poised that if the rate cut will happen, probably we are better poised in terms of our holding in terms of the debt securities. We generally like to have more of accrual type of, or HTM type of securities what we are having. And I think this is what the debt allocation is all about. Again, as I said, that I'm not an expert on the debt side of the holding. For us, what is more important, or the bulk of the return what we generate, is basically from the allocation, the selection of the equity, which generates the bulk of the return on the fund.
Right, right. And just one last thing, which kind of investor do you think is the fund suitable for, both in terms of duration and risk profile?
So anyone who's looking for a stable. So as you know, these funds are dynamically managed, and the drawdowns are typically lesser than the directional funds, or probably the long only funds, typical long only funds with no dynamic asset allocation effects. So these funds will be lesser riskier than the diversified funds. But as you know, less risk carries less returns also. So they in terms of return they will be slightly they will be placed below the diversified funds. But in terms of the scaling up of the category, though these funds will generally deliver higher returns than the equity saving funds in terms of the return and in terms of the risk. Now, our objective is that we tend to target anywhere between 200 to 300 basis point higher than the Nifty as far as the balance advantage type of funds return perspective is concerned. In terms of why these funds are suitable, because these funds generally, and why we are targeting 200 to 300 basis points, because we believe that we have lower drawdowns whenever the market corrects, but whenever the market rallies, because we have the option of increasing equity allocation, we generally participate in the upside while protecting the downside. Now, this is what our objective has been. Who can come into anyone who's looking to have a significant who can take slightly more risk than the equity saving type of fund, but still wants an equity allocation, because this equity allocation can range between 40 to 80%. I think anyone who's looking for a stable, more of a linear type of return, again, it can't be linear because you have an equity exposure, but exposure to equity with a lower drawdown, slightly more lesser risk than the diversified fund, but with significant equity participation as and when the need arises. Basically, when the market gives you an opportunity between 40 to 80%, are the investors who can actually come and invest into it. So I think it is suitable for many of the guys who can't manage their portfolio between the equity and the debt. This is actually a very a good fund who does self-adjusting effect for the investors.
Right, right, right. So thanks a lot, Mr. Shailesh. This really sums up how the portfolio of the fund is positioned, which category does it belong to, which investor is it suitable for. So thanks a lot for candidly sharing a lot of detail with us. I hope our viewers have a better understanding of the category as a whole, and as well as what Tata is doing in the balanced advantage category. Thanks a lot. I appreciate you coming.
Thank you, Nikhil. Thank you for your time.
Thanks.